This is Satya Pradiman of Cirrus Research. The latest briefing report is just out. The briefing is a monthly series that summarizes the market results in terms of broad markets, sectors, industries, factors, and of course our active blends. The title for this month, which closes the year, Nifty-7 dominance with broader finish in 23. I think this chart says a whole lot in terms of the active manager pain felt in 2023. What you'll notice is that the trending factors worked really well. This was truly driven by the hunt for AI and NVIDIA and the broad extended FANG names. What's interesting, however, very different rest of market pattern. And the best way to portray this is to look at whether or not valuations mattered. And in this left panel of the chart, what we're showing is that the valuation stock selection component in our work gained roughly about 24%. In other words, valuations mattered in the smaller cap arena. In the larger cap area, while price momentum performed really well and business momentum, those are like forward estimates, what we noticed is that valuations just did not matter and quality was marginal. At the end of the day, though, this does really explain quite a bit behind the active performance pain and the divergence that we've witnessed between large and small cap active results. Another take on the performance data relates what happened really in the fourth quarter. What we started to witness was a broadening across the cap spectrum. So while really from the second, third quarter, you had a very dominant Nifty-7 effect, the fourth quarter, what we witnessed was something a little bit different. What we'll notice is that the extended FANG names were up 15%, and the ARC ETF innovation was up 32%. And in fact, the Russell 2000 value was up 15%, not to mention the microcap numbers as well. So at the end of the day, what we think is going on here is that there is a broadening underway. If we're right about some sort of relief in terms of interest rate risk, if we're also right about potentially some earnings resilience, to some degree the market will broaden, and we think that will actually drive this sort of 2024 effect, which could be very different from this past year. One final note in terms of the speculative nature of markets and the year-end rally. One of the things that we've really addressed here is this idea that the performance gap between the Russell and the S&P had been quite severe as of 2-3 months ago. Within a short 2-3 months, this gap is closed by over 15% very quickly. As we enter the year, I guess the caution here is to really think about what is a January effect. And to some degree, the seasonals, in terms of the academic literature, it really points to a sort of small microcap pattern at year end going into the start of the year. Some of the literature also suggests that this effect can close within the first few days or mid-month of January. So, like I said, very, very dramatic year, constructive year nonetheless, and really a very challenging period for active managers. With any questions, feel free to call us. Thank you.